Hello everyone, I'm John with JP Strategic Investments, and today I'm going to talk about what Rocket CEO Jay Farner just said on a webcast with Morgan Stanley this morning, and give you guys an update on what I think about Rocket's stock movement today. As always, if you enjoy videos like this, be sure to like and subscribe, and if you want to know exactly what trades I'm making and why I'm making them, be sure to join the JP Strategic Investments Discord server. The invite link is in the description to all of my videos. And with that said, let's dive right in. So just this morning, Jay Farner, Rocket's CEO, was on a webcast with Executive Director at Morgan Stanley, James Fawcett, where they talked about the business and where he sees Rocket in the future. And of course, the first thing that Jay was asked was what he thought about Rocket's recent stock movement, and here's what he had to say.
The stock yesterday and the last few days, really interesting to see for us. Obviously, we had an incredible 2020. And we had our earnings call last week where we talked about the results in 2020. We talked about the fourth quarter. And so a lot of this for me is really the recognition of the Rocket Companies platform. And so the question I've obviously received, and you just asked it, what do I think about the price? Well, everybody on this call is far smarter than I am when it comes to determining the appropriate price for stock. Someone reminded me this morning that even at the high point of our share price yesterday, if you look at the S&P 500 and the average multiple on forward earnings, many of the analysts probably watching would find that our multiple would be lower than the average, even at that high price. So you know how we feel, which is 25 years in the business, all the investment we're making, we are very bullish on where Rocket Companies is headed, and we'll keep making all the right decisions to continue to grow the company.
So first of all, Jay confirmed exactly what I mentioned in my video yesterday, which is that even at yesterday's highs in the low 40s, Rocket was still trading at a discount to most other companies in the S&P. He also mentions that he thinks that this move is partly due to investors finally recognizing Rocket's technology and their potential. It's also important to note that this webcast was part of a technology-based conference. This is important because up until recently, Wall Street categorized Rocket Companies as just another financial company rather than a fintech company or financial technology company. Although now Wall Street is starting to change their tune, with Jim Cramer and David Faber on CNBC talking about how this is absolutely a fintech company. Here's exactly what they had to say.
And frankly, don't understand why the stock didn't react to what was a very good quarter, where they basically laid out a story which just said, we can show you how when rates go up, it has not hurt our business. When rates go down, it's not hurt our business. David, you know Dan Gilbert.
I do.
And you know that Dan is a pretty serious fellow that put together a very good company.
As you pointed out, this is as much a technology company as anything else, and a fintech company. It was one of the largest IPOs we'd seen in a very long time.
Jay also made sure to drive this point home in the webcast when he was asked about how Rocket was able to gain so much market share and scale so quickly in 2020. This was his response.
Yeah, I'm going to start with tech, the scale that the technology brings us, because I'm going to remind you that in addition to all the things you've just stated, everyone's working from home. So we have 22 plus thousand individuals that are at home in their home offices, in their bedrooms, in their kitchens, on their computers working, and so it's really that again is, I think, another check mark of what can this technology platform do.
The reason why this is so important is that fintech companies tend to trade at a much higher multiple than traditional banks and other financial companies. And Rocket currently trades at a PE lower than even most traditional financial institutions. This is why so many Rocket investors, myself included, are so bullish on the stock. And by the way, Google's PE for the stock is completely incorrect. Rocket clearly stated in their earnings report that their 2020 net income was $9.4 billion. So I have no idea why Google thinks their PE is so high. One other thing that I love about Jay's response is that he mentions that everyone is still working from home. This is crazy to think about for me because it means that the Rocket team was able to do over $320 billion in loan originations in the last year and crush the competition, all while sitting on their couches at home. This is a true testament to their technology, efficiency, and their level of customer service. And speaking of customer service, for any of you out there that are new to the stock, one thing that you should absolutely know about Rocket stock is that their customer retention rate is easily the best in the industry. One of the ways that this is measured in the mortgage industry is by what's called a refinance recapture rate. Generally, when you refinance a home, you shop around to see if you can get a better deal with another mortgage servicer. The refinance recapture rate measures what percentage of customers stay with the company when refinancing. Well, surprisingly, the industry average for mortgage servicers is only about 18%, whereas Rocket's is 82%. To give you an even better picture of just how important this is, listen to what James Fawcett said about this on the webcast.
But, I have to go back and once again, building on a point you made earlier, your retention as people go through their life cycles and refinancing and that kind of thing. But grabbing those consumers at that original home purchase is obviously a focus. I remember as we were first getting to know Rocket, we were working with our banks analyst, and she audibly gasped when she heard your retention rates versus what she was used to hearing from her banks that she covers.
If you can do that to a bank analyst at Morgan Stanley, then you must be doing something right. This is also the reason why Rocket puts so much importance on their lifetime value of their customers. Because unlike other lenders, they are actually able to benefit from the lifetime value of their customers. This is also why they're able to justify a much higher marketing budget, as Jay touched on in the webcast.
And with these different products and these different auto, loan, real estate, this is where our marketing machine goes to work. I was talking to the CMO the other day, and I told him, I said, increase the budget. Not by 10 million, but by hundreds of millions, because this is where we can put the pedal down and grab market share and engage with clients. So that's the pattern we've been in over the last 35 years, and I think that's what you'll continue to see us to do.
Jay has made the point many times that because of their ridiculously high retention rate, Rocket is able to justify a higher customer acquisition cost because they know that they are getting much more value from their customers than their competition. And as we just heard from Jay, they are not slowing down with their marketing budget and plan to take full advantage of this opportunity in front of them. Now, obviously the stock is down pretty significantly today, but personally, I'm not too worried because I took some profit on call options yesterday, and I also sold covered calls against my shares. And on top of that, I sold cash secured puts in the low 20s. So a lot of the losses on my shares today are being offset by the puts and calls that I sold. I mentioned in my video yesterday that selling covered calls and cash secured puts are great strategies for investors looking to hedge their position in these situations without putting too much of a limit on their potential gains. Again, if you really want to know exactly what trades I'm making, definitely check out my Discord. As I said before, I agree with Jay that the stock is dramatically undervalued, and I will continue to hold my shares and potentially even buy more until I think otherwise. This has always been a longer term investment for me, so I don't mind holding on right now and buying more, even if the stock drops in the short term. I hope you found this analysis helpful, and if you did, please consider liking and subscribing. Other than that, see you next time, and have a great day.